Haka to Mary Jo Vergara, an economist at Kiwibank. Mary Jo, great to see you.
Hey, Brennan.
Now, it's a big day today. We've got inflation figures out from Stats NZ for the June quarter, showing a 0.5% rise in prices in the June quarter from the March quarter, and a 2.7% rise in the June quarter from the same quarter a year ago. Now, that was slightly lower than what the markets were expecting, I understand. Markets were around the sort of 0.7, 0.8%, and not far off what the Reserve Bank was saying as far back as May, so that was quite a while ago. What did you make of today's figures?
Yeah, I guess we weren't surprised to see a lift in inflation as well. We had it slightly higher, so I guess a slightly better result than what we expected. We always knew that inflation would head higher and potentially will head higher from here. But what we were really looking out for today was just what were the drivers? Was there any, signs of this being more of a persistent increase in inflation, or is this more of a temporary increase in inflation? And thankfully, it looked like there was really nothing in the data to suggest that this is more of a persistent inflation. It's not like during 2021 when we saw a big spike in inflation and it kind of lasted a little bit longer. It seems like the drivers this time around were a bit more temporary, which is good news because that means that inflation expectations should be relatively well contained. And overall, this was a really important release because the Reserve Bank have gone into this data watching kind of mode, and this was really the first test for rate cut in August. I think the data points to, or opens the door quite widely for a cut in August.
And on that aspect of, the headline is a bit higher, but it isn't so bad. So 2.7% annual inflation versus 2.5% in the March quarter. What makes you say that it's, reasonably fleeting, so to speak? It's not a, core underlying issue.
Yeah, I guess that was basically at the core, the underlying trend. It ticked a little bit higher to 2.7% from 2.6. It's still within the Reserve Bank's 1 to 3% target band. And you look at things like the domestic inflation picture, that really is trending south. That continues to fall. Non-tradables came in at 3.7%, the first time it's been below 4% on an annual basis in 4 years. Construction, housing-related inflation altogether was really weak. I think construction costs actually fell 0.1% over the June quarter. That's the weakest since 2011. On the year, construction costs were up just 0.8%. That's the weakest since the GFC, and if you go beyond that, the weakest since I think 1999, which there's another recession. So you really only see this kind of weak housing-related inflation in times of recession. So the economic undercurrents are still very weak. There's some frustration out there around council rates still being quite high, electricity being quite high, but the influence that the Reserve Bank has on the interest rate sensitive parts of the CPI basket are really working. There is no need to keep rates restrictive.
Yeah, because when I look at the inflation figures, you can sort of break them down into stuff that's coming from overseas. So, petrol prices, milk and cheese prices, all of those internationally set prices. And that's the tradable stuff. And that obviously came off in large part because of that fuel, as you say. Then you've got the domestic inflation, and that's coming from various places. It might be education, it might be health, retail, the government themselves, the central government through fees and charges, and the local government through rates. And then you've got rents and all of that sort of thing. When I look at those, the things that the Reserve Bank can influence can't influence international prices. We have an open border. There's not much that we don't set prices anymore. We can't touch that. Secondly, there's all the stuff that comes out of the government, local government and central government, which you could call administered inflation. Now, in theory, they should worry that it's going to create inflation when they put up prices, but they don't seem to have worried much in the last 6 to 12 months. And, they're not responsive to interest rates, you'd think. Because actually the government's net borrowing costs are less than 1% of the revenues. But anyway, it counsels a bit more. And then we have a whole chunk of the economy. So electricity, you could argue retail fuel, telecommunications, supermarkets, insurance, where you've got, according to the Commerce Commission, potentially, monopoly, duopoly, situations where there's not as much competition as everyone would like. And, they fall more into the administered inflation camp, which I noticed the Reserve Bank's Monetary Policy Committee actually mentioned the word administered inflation in their last statement. How does the Reserve Bank then actually influence inflation if it can't touch tradable, it can't touch government, and it can't really do much about a lot of this, monopoly, duopoly inflation we get from various sectors?
Yeah, it is. It is a very big frustration, I think, for the Reserve Bank because if you look at non-tradables, that's falling. It continues to fall. It peaked at 6.8% in 2023. It's fallen to 3.7%, and that's falling, but not as fast as you'd expect it to be falling, given how large our output gap is. So the economy is really weak right now. You'd think that there'd be a lot of downward pressure on domestic prices, and there is, but it's just that this administered cost is keeping domestic inflation quite elevated. It really should be around 3% on a year-on-year basis for inflation overall to be said to be contained. So the reason why it's being kept elevated is precisely because of this administered cost, which the Reserve Bank has very little control over. If you exclude that kind of those, I think if you exclude council rates from non-tradables actually comes in at 2.8%. So that kind of tells you how strong or how persistent the strength is in administered costs that's keeping overall domestic inflation elevated. So I think the Reserve Bank will will look favorably on the non-tradables, how that's continuing to fall, but it's just that frustration there.
So the Reserve Bank decided not to cut interest rates at its last decision. Its next decision is on August the 20th. What's your view now on not only what it should do, but what it might do?
I think this time around, I think that what it should do and what it will do might actually align. We think that they should be cutting interest rates, and we think that this data really opens the door for a rate cut in August. As I said, it was kind of their first test. Now that they've moved into this data watching, the data came in broadly in line with what they expected. Some even good news on that domestic inflation front, just falling. We do have, labour market data and inflation expectations, and other two key results before they meet and give their decision in August. And this inflation data should inform those inflation expectation survey as well. So that should hopefully, not see expectations run wild and actually see that medium-term inflation expectations relatively contained. So I think the data points to medium-term inflation being well contained, and that does open the door for a rate cut in August.
So that's 25 basis points. That takes us down to 3%. What do you think it should go to? Where does it trough or flatten out?
We still think 2.5%, just to get that cash rate, firmly within that stimulatory territory. We are in the neutral zone, and it has, the neutral cash rate, the Goldilocks cash rate has quite wide confidence bands, but it should be in that sort of stimulatory zone, because we've seen the economy recover from the deep recession we had last year. But to really secure that, the government's tied their hands, self-tied maybe, in terms of delivering growth. But so it really rests on the Reserve Bank to kind of secure and guarantee that economic recovery, one that's more broad-based, and they can do that by delivering more rate relief.
So people who might want to get a mortgage and buy a home, will they see these future official cash rate cuts in their mortgage rates? Because one of the issues we've seen from international interest rates, longer term bond yields, and even our own bond yields, is that they haven't been falling much recently. So what's the story with mortgage rates, therefore, particularly the fixed rates?
I think if the Reserve Bank does go down to 2.5% is the cash rate terminal, we could see those retail rates, those fixed rates, fall a little bit lower, mostly because it's not quite priced in the market. So we'll see wholesale rates fall, and that should feed through to retail rates. But most of the move in interest rates has already been, so the Reserve Bank's delivered 225 basis points. That's already had most of the effect on retail rates. So we could see it fall a little bit further, but we are nearing the bottom of this interest rate cycle. Because of what's happening overseas, that pressure being on bond yields, it could mean that these low rates won't stay as low for as long, as we would have thought without this offshore developments, because they are, wholesale rates to some extent are influenced by what's happening overseas.
Because for a long time, a year or so, a lot of, politicians, economists, people in business have gone, yay, 225 basis points. That should be enough to get us going. But it doesn't feel like we got going. And it seems like this is as good as it gets, for at least for fixed mortgage rates. So what do you think's going on here?
Yeah, it's been really interesting because, as you said, there's been a lot of easing. I think we expect, there is this big mortgage wave that's still coming, this mortgage refixing that's still coming. It should help, households, those mortgage households, get onto those lower rates, and it should, spur a bit of activity and consumption and business investment. But it just seems, I think it's just how deep the recession was. We just needed extra help. I think that 225 basis points is enough. It's really about getting interest rates a little bit lower, that 2-year maybe closer to 4.5%, that households will feel a bit more confident in terms of spending, businesses can jump back in, and we'll see investment intentions boost a little bit more. So I think it's just a little bit more about getting the extra help.
Mary Jo Vergara, a senior economist at Kiwibank, talking about today's CPI, consumer price inflation figures for the June quarter. Mary Jo, ngā mihi nui.
Thank you.